At 2:47 a.m. Eastern Time on February 3, 2026, the Federal Reserve held an unscheduled emergency meeting. This was only the fourth emergency meeting in 16 years. The last three were March 2020 during the COVID crash, September 2019 during the repo market crisis, and October 2008 when Lehman Brothers collapsed. By 6 a.m., before most Americans had their morning coffee, gold had blown past $6,000 per ounce. And if you think this is just about gold going up, you're missing what's actually happening to the dollar. The mainstream financial media is calling this a technical breakout and a flight to safety. They're showing you charts with moving averages and talking about momentum traders and algorithmic buying. CNBC had 3 analysts on this morning explaining why gold is overbought and due for a correction, but that's not what's happening. What's happening is that 3 major central banks quietly informed the Federal Reserve last week that they would not be rolling over $340 billion in U.S. Treasury holdings. What's happening is that the SWIFT international payment system processed an unprecedented $47 billion in physical gold settlement transactions in a single 72-hour window. What's happening is that the Federal Reserve is losing control of the one thing that has held the global financial system together for 53 years: confidence in the dollar. Gold breaking $6,000 is not a story about gold. Gold is just the thermometer. The fever is in the dollar. This is the visible symptom of a currency crisis that's been building beneath the surface for 18 months and just went critical. The Fed's emergency meeting at 2:47 in the morning wasn't about calming markets or reassuring investors. It was about preventing a cascade failure in the Treasury market that would make 2008 look like a minor correction. I'm going to show you what actually happened in that emergency meeting based on information that hasn't been reported in mainstream financial media. I'm going to name the 3 central banks that triggered this crisis and explain exactly why they chose this moment to act. I'm going to walk you through the specific 4-phase timeline of what happens to the dollar over the next 6 to 18 months based on historical patterns that have played out multiple times before. And I'm going to tell you what this means for your savings, your retirement accounts, and your purchasing power, because the decisions you make in the next 90 days will determine whether you're protected or devastated by what's coming. If you want to understand what's really happening to your money before the financial media sanitizes this story and tells you everything is fine, subscribe to this channel. We've been tracking dollar instability and central bank gold accumulation for over 2 years, and everything we warned about is now playing out faster than even we expected. But first, let me show you what really happened in that Fed meeting, because the official statement they released is 31 words of carefully crafted nothing, and the gap between what they said and what they did tells you everything you need to know about how serious this situation has become. Here's the official statement the Federal Reserve released after their emergency meeting. Quote, "The Federal Open Market Committee convened to assess current conditions in global financial markets and to evaluate appropriate policy responses to ensure continued stability in Treasury market functioning." End quote. That's Fed speak. Let me translate what that actually means. Foreign central banks are dumping treasuries so fast that the Federal Reserve had to step in as the buyer of last resort to prevent a failed treasury auction. And a failed treasury auction would be the financial equivalent of a cardiac arrest for the global economy. The patient doesn't recover from that without permanent damage. Here's how the Treasury market works and why this matters so much. The United States government needs to borrow approximately $2 trillion every single year just to cover the budget deficit and roll over maturing debt. They do this by selling Treasury bonds at auction. For 40 years, foreign central banks have been the reliable buyers of these bonds. China, Japan, Saudi Arabia, and the oil-producing nations accumulated trillions of dollars through trade surpluses. And they parked those dollars in Treasury bonds because Treasuries paid interest and were considered the safest asset in the world. But something broke in late 2024. Foreign holdings of U.S. Treasuries, which had been growing steadily for decades, started declining. Not slowly, rapidly. According to Treasury International Capital data released last month, foreign official holdings have dropped by $890 billion in the last 14 months. That's $890 billion in Treasury bonds that foreign governments sold. And every bond they sell needs a buyer on the other side. Now here's where it gets dangerous. A source within the Federal Reserve System provided details about the emergency meeting to a financial newsletter that tracks central bank activity. What they revealed explains why the meeting happened at 2:47 in the morning and why gold exploded within hours. According to this source, the emergency meeting was triggered by a specific event that occurred the previous afternoon. The People's Bank of China, the Bank of Japan, and the Saudi Arabian Monetary Authority collectively informed the New York Fed through official diplomatic channels that they would not be rolling over $340 billion in Treasury holdings maturing in the second quarter. This wasn't a gradual reduction. This wasn't slowing down their purchases. This was three major holders announcing simultaneously that they were walking away from new Treasury purchases entirely. The Fed asked them to reconsider. According to the source, there were frantic calls between Fed officials and their counterparts in Beijing, Tokyo, and Riyadh throughout the evening. They declined. The Fed offered preferential rates on new Treasury issuances, essentially promising to give them better yields than other buyers would receive. They declined. The Fed even offered to conduct direct bilateral currency swaps to ease any dollar liquidity concerns these central banks might have. They still declined. That's when Federal Reserve officials realized this wasn't about interest rates or liquidity conditions. This was a coordinated decision. Three major economies that have been financing American deficits for decades had decided together that they no longer wanted to hold American debt. And when your creditors stop lending to you simultaneously, that's not a market event. That's a financial intervention. Here's why the Fed is terrified and why they should be. The United States currently has $4 trillion in national debt, approximately $9 trillion of that debt matures and needs to be refinanced in the next 12 months. If foreign buyers step back and domestic buyers can't absorb the supply, the Fed has only one option. They become the buyer. They print dollars and use those newly created dollars to purchase Treasury bonds. When a central bank prints money to buy its own government's debt, that's called monetization. And monetization is the path that Weimar Germany took in the 1920s, that Zimbabwe took in the 2000s, that Venezuela took in the 2010s, that Argentina has taken repeatedly. It's the path that leads to currency collapse and hyperinflation. The Fed knows this. They've studied every one of these historical cases. They know exactly how currency collapses begin, how they accelerate, and how they end. And they're watching the first stages unfold in real time with no good policy options to stop it. Gold breaking $6,000 per ounce is the market's way of sending a message to the Federal Reserve. The message is simple. We see what you're doing. We see that you're going to have to print trillions of dollars to finance government debt because your foreign creditors are leaving. And we don't trust the dollar anymore. But the Fed emergency meeting and the Treasury crisis are just the immediate trigger. To understand why gold didn't just rise but exploded past $6,000 in a matter of hours, you need to understand the three converging forces that all hit the market simultaneously. And the third one, the one involving the COMEX futures exchange, is the force that nobody in mainstream financial media is talking about. The Fed emergency meeting explains why gold moved, but it doesn't explain why gold moved so fast and so far. A $800 per ounce move in 72 hours isn't normal price action. That's a market structure breaking. To understand the velocity of this move, you need to understand three forces that converged at exactly the same moment. Each one alone would have pushed gold higher. All three together created an explosion. The first trigger is central bank accumulation going vertical. For the last 3 years, central banks around the world have been buying gold at a pace not seen since 1967. According to World Gold Council data, central banks purchased 136 tons in 2024. They were on pace for over 1,400 tons in 2025. And then something unusual happened. The World Gold Council, which has published quarterly central bank gold demand data for over 30 years, stopped reporting official sector purchases in the third quarter of 2025. They cited data collection challenges. That's institutional language for the numbers are so extreme that publishing them would destabilize markets. But we can piece together who's buying from customs data, refinery shipment records, and central bank balance sheets that are still publicly available. China's official gold reserves stand at 2,264 tons, according to the People's Bank of China. But that number hasn't been updated in months, and analysis of Chinese gold imports through Hong Kong and Switzerland, combined with domestic mine production that never leaves the country and a complete absence of gold exports, suggests actual holdings somewhere between 5,000 and 8,000 tons. The Chinese have been accumulating in secret for over a decade, reporting only occasional small additions, while the real buying happened through state-owned banks and sovereign wealth vehicles that don't appear in official reserve data. Russia's central bank holds 2,336 tons officially and has been adding approximately 30 tons per month since Western sanctions made their dollar reserves effectively worthless. They've publicly stated their intention to back 20% of the ruble with gold reserves. They're not hiding their strategy, they're advertising it. But the buyer that matters most is Saudi Arabia. The kingdom has historically held minimal gold reserves, around 323 tons, which is tiny for an economy of their size. But in the last 18 months, multiple sources in the bullion market report that the Saudi Sovereign Wealth Fund has been accumulating physical gold through private transactions that don't appear in official reserve data. Estimates from London bullion dealers range from 400 to 800 tons of undisclosed purchases, paid for in dollars, that Saudi Arabia no longer wants to hold. Why does Saudi Arabia matter more than China or Russia? Because Saudi Arabia has been the linchpin of the petrodollar system since 1974. The deal was simple. Saudi Arabia prices oil in dollars and recycles their oil profits into U.S. Treasury bonds. In exchange, the United States provides military protection for the kingdom. This arrangement has forced every country that imports oil to hold dollars, which created constant global demand for the American currency. If the Saudis are dumping dollars for gold, it signals that even America's closest financial partners have lost confidence in the currency. The petrodollar system that has supported the dollar for 50 years is fracturing. The second trigger is an industrial demand shock that nobody saw coming. Most people think of gold as money or jewelry, but gold is increasingly a critical industrial input, and demand from technology and manufacturing has exploded. Every smartphone contains approximately 0.034 grams of gold in its circuitry. Every computer, every server, every data center running artificial intelligence models. As the AI infrastructure build-out has accelerated globally, gold demand from the electronics sector increased 23% year over year, according to the latest industry data. Medical applications have grown even faster. Gold nanoparticles are now used in cancer treatment, diagnostic testing, and targeted drug delivery systems. Medical gold demand has tripled since 2020 and shows no sign of slowing. Aerospace and defense applications are expanding as satellite production ramps up, and military systems require gold's unique conductivity and corrosion resistance properties. Defense sector gold consumption is up 40% in 2 years. The critical point is that industrial users cannot substitute. When gold prices rise, they don't switch to silver or copper or aluminum. They need gold specifically for properties that no other element provides. Industrial demand is what economists call price inelastic. It doesn't decrease when prices rise. These buyers pay whatever they have to pay because their products don't work without gold. Meanwhile, supply isn't keeping up. Global gold mine production peaked at 3,300 tons in 2018, according to the U.S. Geological Survey, and has declined slightly every year since. There are no major new deposits coming online in the next 5 years. The easy gold has been found. What remains is deeper underground, lower grade ore, and more expensive to extract. You have central banks buying at record pace, industrial users buying at increasing pace, and mine supply flat to declining. The math doesn't balance. Something has to give, and what gives is price. The third trigger is the one that mainstream financial media refuses to discuss because it exposes how the gold market actually works. The COMEX futures exchange is cracking. For decades, the gold price has been determined not by physical supply and demand, but by paper trading on futures exchanges. Banks trade contracts representing hundreds of millions of ounces of gold, and most of those contracts are settled in cash rather than physical metal. The paper market overwhelms the physical market by a ratio of approximately 100 to 1. For every ounce of real gold that exists, there are 100 ounces worth of paper claims trading on exchanges. This system works as long as almost nobody asks for physical delivery. But in January 2026, something unprecedented happened. Standing for delivery on COMEX gold contracts hit an all-time record. Over 28 million ounces, representing 875 tons of gold, stood for physical delivery in a single month. The problem is that COMEX registered inventory available for delivery totaled just 18 million ounces. That's a 10 million ounce shortfall. Banks that sold paper gold they didn't actually have are now scrambling to source physical metal in a market where central banks and industrial users are also competing for limited supply. When the paper market's ability to suppress prices through unlimited synthetic supply finally breaks, price discovery shifts to the physical market. And physical market prices don't rise gradually. They gap, they jump. They move in hundreds of dollars per day instead of tens. The move from $5,200 to $6,000 happened in 72 hours because short sellers were covering into a market with no available supply. This isn't the end of the squeeze. This is the beginning. If you're thinking this situation sounds unprecedented, you're wrong. This exact pattern has played out multiple times in history, and every time it ended the same way. Understanding these historical parallels tells you not just that gold will go higher, but approximately how much higher and how fast. The first parallel is the collapse of the London gold pool between 1961 and 1968. During the 1960s, the United States and 7 European countries formed a consortium to suppress the gold price. Under the Bretton Woods system, the dollar was pegged to gold at $35 per ounce, and the U.S. had promised to exchange dollars for gold at that rate. But America was printing too many dollars to finance the Vietnam War and domestic spending programs. Foreign governments started exchanging their dollars for gold, draining U.S. reserves. The London Gold Pool's job was to sell gold into the market whenever private demand threatened to push prices above $35. For 7 years, the suppression worked. But by 1968, physical demand had become so overwhelming that the pool was losing 100 tons of gold per day trying to hold the price down. On March 15, 1968, the London Gold Pool collapsed. The 8 countries announced they would no longer sell gold to private buyers at the official price. The gold price immediately rose to $44 in the free market. 3 years later, President Nixon closed the gold window entirely, ending any convertibility between dollars and gold. And over the following decade, gold rose from $35 to over $800 per ounce. That's a 23x increase. The pattern is clear. Price suppression through paper mechanisms works until physical demand overwhelms the available supply. Then the suppression fails catastrophically, and price discovery becomes violent. The second parallel is the gold explosion of 1979 to 1980. In the late 1970s, America faced conditions remarkably similar to today. High inflation eroding purchasing power, loss of confidence in the dollar after Vietnam and Watergate, geopolitical instability with the Iranian Revolution and Soviet invasion of Afghanistan, government debt that seemed unmanageable at the time, though it was a fraction of current levels. Gold rose from $200 per ounce in January 1979 to $850 per ounce in January 1980, a 325% increase in 12 months. At its peak, gold was pricing in the complete collapse of the dollar. The entire U.S. gold reserve at Fort Knox, valued at $850 per ounce, would have been needed to back the currency. The Federal Reserve's response was brutal but effective. Paul Volcker raised interest rates to 20%. This crushed inflation, crushed the economy, caused a severe recession with unemployment over 10%, and brought gold back down from its highs. The dollar was saved through economic pain. Here's why that response is impossible today. In 1980, total U.S. government debt was $900 billion. At 20% interest rates, the annual interest cost was painful but manageable for the federal budget. Today, U.S. government debt is $36, $4 trillion. If the Fed raised rates to 20% to defend the dollar, the annual interest cost would be $7, $3 trillion. The entire federal budget, including military, Social Security, Medicare, and all other spending, is only $6, $8 trillion. The government would be spending more on interest payments than on everything else combined. It would be immediate bankruptcy. The Federal Reserve is trapped. They cannot raise interest rates high enough to defend the dollar without destroying the government's ability to function. So they will do what trapped governments throughout history have always done. They will let the currency depreciate and pretend it's not happening. They will call it temporary. They will blame external factors. And gold will continue rising as the market prices and what the Fed cannot admit publicly. The third parallel is Weimar Germany's hyperinflation of 1921 to 1923. Most people misunderstand what happened in Weimar. They think Germany printed money, and that caused hyperinflation. But printing money was the symptom, not the cause. The cause was a collapse in confidence. Germany printed money to pay war reparations they couldn't afford through taxation. Foreign holders of German marks saw this and started selling. As they sold, the mark fell in value. As the mark fell, Germany needed to print even more to buy the same amount of goods, which caused more selling, which required more printing, a doom loop that fed on itself. The critical lesson from Weimar is that the collapse was not linear. For 2 years, inflation was elevated but manageable. Prices doubled, people complained, but society continued functioning. Then in 1923, confidence collapsed completely. Prices didn't just rise, they doubled every few days. By November 1923, a loaf of bread cost 200 billion marks. The phased transition from high inflation to hyperinflation happened faster than anyone predicted. We are in the manageable phase right now. Inflation is elevated but not catastrophic. The dollar is weakening but not collapsing. But confidence is eroding with every emergency Fed meeting, every failed Treasury auction that gets papered over, every central bank that quietly dumps dollars for gold. Gold at $6,000 is the market's confidence meter, and the needle is moving into the red zone. The convergence we're witnessing today combines all the elements from these historical episodes simultaneously. The paper suppression mechanism is breaking like the London Gold Pool. Government debt is unmanageable like 1980, but worse. And confidence is eroding in a pattern that echoes Weimar's early stages. History doesn't repeat exactly, but it rhymes. And right now, the rhyme scheme is pointing toward a dramatic repricing of gold against the dollar. based on historical patterns and the current trajectory of central bank behavior, here's the most likely timeline for how this crisis unfolds. I'm not predicting exact dates because markets don't follow calendars, but I am predicting a sequence, and that sequence is already underway. Phase 1 is the official denial phase, and we're living through it right now. This is the period where government officials and mainstream financial media insist that everything is under control. You'll see Federal Reserve governors appearing on Bloomberg and CNBC explaining that markets are functioning normally and that the recent volatility in gold prices reflects speculative excess rather than fundamental concerns about the dollar. Treasury Secretary Janet Yellen or her successor will give interviews emphasizing that the dollar remains the world's reserve currency and that foreign demand for treasuries is robust. The White House will blame speculators, possibly foreign governments, for manipulating commodity markets. There may be congressional hearings where politicians express concern about gold market speculation and call for investigations. Behind the scenes, something very different will be happening. The Federal Reserve will conduct massive Treasury purchases to prevent auction failures, but they won't call it quantitative easing. They'll use terms like liquidity support operations or market functioning interventions. The Treasury Department will quietly shorten the average maturity of new debt issuance, selling more short-term bills instead of long-term bonds because short-term debt is easier to place. This stores up even more refinancing risk for the future, but it solves today's problem of finding buyers. Gold prices during Phase 1 will be volatile. Expect sharp pullbacks of $300 to $500 per ounce as the paper markets attempt to regain control, followed by rallies to new highs as physical demand continues overwhelming supply. This volatility serves a purpose. It shakes out weak holders, discourages retail participation, and allows institutions to accumulate at lower prices before the next leg up. If you understand what's happening, the volatility is an opportunity. If you don't, it's a trap designed to separate you from your position. Phase 2 is the international fracture, and it likely begins within 3 to 6 months. This is when the coordinated foreign selling of treasuries becomes impossible to hide or explain away. Watch for specific signals. A treasury auction with what's called a tail, meaning the government has to pay significantly higher interest rates than expected because demand was weak. A public statement from China, Japan, or Saudi Arabia about diversifying reserves away from dollar assets. An IMF report questioning the sustainability of dollar reserve status. A BRICS summit announcing concrete mechanisms for trading oil, commodities, or manufactured goods and currencies other than dollars. Any single one of these events will be dismissed as isolated or temporary. When 2 or 3 happen within weeks of each other, the narrative shifts. Financial media transitions from gold is overbought to gold is reflecting legitimate concerns about fiscal sustainability. This narrative shift is important because it gives institutional money managers permission to buy. Pension funds and endowments that couldn't justify gold positions when mainstream consensus said gold was a speculative bubble can suddenly allocate when mainstream consensus says gold is a prudent hedge. Gold during Phase 2 likely reaches $7,500 to $8,500 per ounce. Silver, which has lagged gold during the initial move, plays catch-up as investors seek cheaper entry points into precious metals. The gold-to-silver ratio, currently around 85 to 1, could contract toward the historical average of 50 to 1, meaning silver potentially triples while gold doubles. Mining stocks, which provide leveraged exposure to metal prices, could see gains of 200% to 400% from current levels. Phase 3 is the domestic awakening, beginning roughly 6 to 12 months from now. This is when ordinary Americans who don't follow financial markets realize something is wrong. Not because they read the Wall Street Journal, but because they experience it in their daily lives. Grocery prices rise noticeably, not the 5% to 8% annual increases that Americans have reluctantly accepted, but 15% to 25% in a single quarter. Eggs, meat, bread, vegetables. Everything costs more, and the increases accelerate. Gas prices spike above $6 per gallon nationally and stay there regardless of what happens in oil markets because the dollar's purchasing power is collapsing. Rent increases accelerate as landlords pass through their own rising costs for maintenance, insurance, and property taxes. The official inflation number reported by the Bureau of Labor Statistics will show 7% or 8% annual inflation. Real experienced inflation, what you actually pay for the things you actually buy, will be running 15% to 20% or higher. The gap between government statistics and lived reality becomes a source of public anger and political instability. People know they're being lied to. They just don't know exactly how or why. Gold during Phase 3 becomes a mainstream topic. Your coworker mentions buying gold coins. Your brother-in-law asks what you think about precious metals. Local coin shops have lines out the door and waiting lists for popular products. Google searches for how to buy gold spike to levels not seen since 2011. Premiums for physical gold coins and bars, already elevated, explode to 20% or 30% over spot price. Delivery times extend to weeks or months. Phase 4 is the restructuring, likely beginning 12 to 18 months from now. This is the phase where the current monetary system either transforms or collapses. The outcome depends on political decisions that are inherently unpredictable, but the direction of gold prices is the same, regardless of which path unfolds. Understanding what's happening is worthless if you don't act on it. So let me be specific about what this means for your money and what you should consider doing about it. If you already own physical gold, you're watching everything you prepared for finally arrive. You've probably been called a doom and gloomer, a gold bug, a conspiracy theorist. Your financial advisor probably told you that gold doesn't pay dividends and underperforms stocks over the long term. Your friends probably thought you were paranoid, but you understood something that the mainstream missed. You understood that paper claims on wealth are not the same as wealth itself. And you understood that systems built on confidence can collapse when confidence erodes. Here's what you need to know going forward. Don't trade your position trying to catch short-term swings. The temptation during volatile markets is to sell on spikes and buy back on dips. In normal markets, this can work. In a currency crisis, it gets you left behind. Gold can gap up $400 in a single session and never return to previous levels. If you sell waiting for a pullback that doesn't come, you've converted real wealth into a currency that's actively losing purchasing power. The point of owning physical gold is that it's outside the system. Selling it for dollars puts you back inside the system at exactly the wrong moment. Think about your storage. If your gold is in a bank safe deposit box, understand the risks. Banks can restrict access during financial emergencies. We saw this in Greece in 2015 when banks limited withdrawals and safe deposit box access during the debt crisis. We saw it in Cyprus in 2013 when depositors had their accounts frozen and partially confiscated. The United States is not Greece or Cyprus. But the United States in a dollar crisis is not the United States you grew up in either. Consider allocated storage outside the banking system or direct physical possession for at least a portion of your holdings. If you don't currently own gold, you're not too late. But you need to approach buying differently than if you had started a year ago, except that you will pay higher prices. Gold at $6,000 feels expensive if you remember gold at $1,800. But anchoring to past prices is a psychological trap. If the analysis in this video is correct and gold reaches $10,000 to $15,000 over the next 12 to 18 months, then $6,000 is still early. You're not buying the bottom, but you're also not buying the top. Prioritize physical metal over paper products. Don't buy GLD or other exchange-traded funds as your primary gold exposure. The entire thesis of what I've explained today is that paper claims on gold are being exposed as unreliable. COMEX can't deliver the gold it's contractually obligated to deliver. ETF custodians may be lending out metal that's supposed to be sitting in vaults. Own coins and bars that you can hold in your hand, verify with your own eyes, and if necessary, transport yourself. American Gold Eagles, Canadian Maple Leafs, Austrian Philharmonics, 1-ounce bars from recognized refiners. These products have global liquidity. You can sell them anywhere in the world. Dollar cost average rather than trying to time perfect entries. Divide your intended allocation into 4 to 6 purchases over 3 to 6 months. This reduces the risk of buying at the exact top of a short-term spike and gives you emotional discipline when prices swing. Expect delays and premiums. Physical dealers are quoting 4 to 8 week delivery times on many products. Premiums over spot price are running 8% to 15% for coins, sometimes higher for smaller fractional pieces. This is the reality of buying during a shortage. Order sooner rather than later, and factor premium costs into your planning. Beyond gold specifically, think about broader financial resilience. Hold some cash outside the banking system for emergencies. Not a lot. Cash loses purchasing power in an inflationary environment, but having 2 or 3 months of expenses in physical currency at home means you're not dependent on ATMs and bank access during a crisis. Pay down variable rate debt aggressively. In a high inflation environment, fixed rate debt actually becomes easier to service because you're repaying with depreciated dollars. But variable rate debt is a trap. When rates rise, your payments rise, and you have no escape. Diversify internationally if you have the means. Holding some assets outside the United States, whether foreign real estate, foreign equities, or simply a bank account in a stable foreign jurisdiction, reduces your dependence on the dollar specifically. This isn't unpatriotic, it's prudent risk management that wealthy families have practiced for generations. Let me leave you with this. The Federal Reserve held an emergency meeting at 2:47 in the morning because the system they manage is breaking. Gold exploded past $6,000 because markets are losing confidence in the dollar. 3 major central banks refuse to finance American debt because they see where this trajectory leads. History tells us exactly how these situations unfold. The math tells us the Fed has no good options. And gold, the one form of money that cannot be printed by any central bank, is telling us that the reckoning is here. I don't know if gold goes to $10,000 or $15,000 or $25,000, but I know the current price doesn't reflect the severity of the dollar's problems, and I know that by the time the mainstream financial media admits what's happening, the opportunity to protect yourself will have largely passed. If you found this analysis valuable, share it with someone who needs to hear it, and I'll see you in the next one.